Welcome to today's webinar. We will begin in just a few moments. This is Kat Hungerford with AAPL. All right, let's go ahead and get today's webinar started. As you all know, you are joining us to listen to a webinar on lions, tigers, and bears competing for commercial and multifamily bridge loans. Before I hand it off to Don, I do want to take care of a couple housekeeping items. I am Kat Hungerford, Business Development Manager at the American Association of Private Lenders. We are having a conference coming up this November 7 through 9, and we are taking registrations online at aaplconference.com. We are very excited. This will be our 10th annual conference. We have a special keynote this year. Former Congressman Barney Frank, who, as many of you know, was the half of the duo of the infamous Dodd-Frank Act. So, moving on to our webinar today, we have lions, tigers, and bears competing for commercial and multifamily bridge loans. We will have both Jay and Don Pelgrim here today to present the webinar. Don't get lost in the shuffle. Learn how to grow your business and income in an increasingly competitive commercial and multifamily bridge lending environment. Don Pelgrim, CEO of Wilshire Finance Partners, will show you how his private debt funds are used by brokers as a funding platform and springboard into commercial and multifamily bridge lending. As we do go through today's webinar, I invite you to ask questions in that question box. Don will be pausing throughout the program to go ahead and answer the questions that have come through, along with a QA at the end. We will be keeping track of anybody who raises their hand if you would like to speak during that question period, but for best audio quality, we do really encourage you to put everything into that question box there. And with no further ado, here is Don.
Hey, thank you very much, Kat. This is actually Jay Ash with Wilshire. I've got Don is also on the line with me. We certainly appreciate the opportunity to present to all of you and get a chance to get in front of you all. Really, Wilshire. What Wilshire is we're a structured debt platform. We're a direct portfolio lender. We manage 2 debt funds and a debt REIT. We are we're really only doing bridge loans. We do loans from about 1 to 10 million in size. We do multifamily and commercial real estate. We really don't do land, hotels, or ground up construction. And we hold everything on our balance sheet. So we're a direct lender, and that's kind of the framework from which we navigate through the market that we're going to go into with you guys right now. The way that we get our money is we get our money through Fidelity and TD Ameritrade. We operate, as you're seeing now, 2 different income funds, the Income and the Opportunity Fund, and we are basically designed to be kind of a capital engine for you guys. And what I was going to tell you about Don and I give you a little color on the 2 of us. Don is the CEO of Wilshire Finance Partners. He's our handles all of our funds, does all the fundraising, including does the yeoman's amount of work around here. He was a former bank executive, and that's kind of where our baseline comes from as previous bankers. You'll see my smiling face there as well, which I'm still contesting why my photo needs to be on here, but I am the VP of Income Property Lending. My background goes back about 20 years. I was with the FDIC. I've done equity, debt, a variety of other things, but that's kind of the baseline from which we view the world as well. And then I think with that, I will kind of give you guys a quick overview of the agenda and what we wanted to try and go through today. We wanted to give you a glimpse of our world, of our view of the current market, as well as the resulting challenges that we're encountering and what we hope you guys are encountering as well. How we're navigating the solutions, or how we're coming up with ideas to get through the challenges, and obviously just kind of wrap it up with some final thoughts. And with that, I can hand it over to Don, who will kind of take you through the balance of this.
Thanks, Jay. I appreciate the introduction. So what I'm going to do here is I'm going to start out with where we stand and what's happening in the current marketplace. And where we sit right now is that it's a very saturated market. There's a lot of money out in the marketplace chasing fewer and fewer good deals. And what we're finding is that some brokers and lenders, even including lenders like ourselves, are spending more time on some of these transactions, including more time on marginal deals, as opposed to focusing in on the stronger credits that'll actually get done. What we're also seeing because of that capital is a little bit more of a lack of control. Borrowers are using multiple brokers, and brokers are using other brokers to source capital. So we're seeing these truncated transactions now. Some of the lenders in the marketplace don't have discretionary capital. They may be people that rely on individual trusted investors, and those investors may be in or out of the market as opposed to that lender being in the market all the time. So we're seeing some of those challenges occurring as well. We're seeing loans move between intermediaries. In other words, there might be a wrong match between the transaction needs and the lender requirements, or the lender risk tolerance. So at this stage of the marketplace, we're seeing very much a shotgun approach by some people versus a more rifle shot, where they're working directly with a lender that they've vetted and they know can do the deal. And some evidence of that are the blind emails that you get, where it's not directly sent to you, but it's sent to a blind pool of people, and we're seeing a few more of those in the marketplace as well. Now, some of those intermediaries are not direct lenders, as I mentioned before, and that might be facilitating the movement between intermediaries, and why some of these guys are actually not performing on these transactions. And again, I've talked about it in a couple of different ways, but the bottom line is that you start to see more daisy chains, and that makes it tougher to get these loans through. And the loans that tend to be the rougher transactions or the tougher transactions seem to be making the circuit. In other words, a number of people are trying to work on those transactions, trying to place those transactions, and as a result of that, lenders like ourselves might see a transaction a couple of times from different sources. And what that leads to then, in terms of the challenges, is a little bit of taint on the deal. In other words, the red flags for something that's been around the block quite a bit are the blind copied emails, the number of brokers, or that truncated chain of people that are in the deal itself, the length of time that a deal might be in the market. Interestingly enough, I saw a transaction about a week ago from a broker, and all the information in the transaction was from 2016. So they didn't take any time to really update the package or look at the package and really put together a presentation that a lender like Wilshire could really sink our teeth into and get a better sense for what we can do on that particular deal. In other words, just very, very stale. So as a result of that, the transaction itself starts to get a little bit of a reputation, and lenders will start to summarily pass on it because of the presentation of the transaction or the reputation that the deal has. That also leads to deal fatigue, where the borrower and other parties get burnt out on a transaction. The borrower may even be paying duplicate fees. They might have paid for multiple appraisals or multiple application fees, so on and so forth. And there might be duplicate and new requests for information because now people are working with different lenders. Also what occurs is that you've got presentation deterioration. And as the broker is too far removed from the borrower, they don't know the transaction very well, and they may be pushing for elements of the transaction that are not necessary. So for example, they might be pushing for a particular loan to value or particular transaction terms that they believe to be true, but they really don't know whether or not it's really needed because they're not in direct contact with the borrower. And what we've done as a post-mortem review of certain deals that theoretically went elsewhere, we've looked at those transactions later on, a few months later, and we see that a number of them have not gotten done, or they've gotten done on terms that were dramatically different than the terms that were represented to us. In other words, not the terms or the push that the broker was looking for, but on more reasonable terms. You know, for those of you that are, you know, in the business for a long while, you know, we used to see that back in the day as well. And if you remember paper loan files, you would see the dog-eared pages and coffee stains on a file, and you would know that that was around the block. Well, you know, some of the telltale signs of a transaction that's been around the block is getting multiple emails with information that might be all over the board. The information is disparate. It's not labeled. It's not very organized, and the broker, when you talk to them, really doesn't know much about the transaction. So ultimately what that leads to is frustrated borrowers. The borrowers are looking at their broker, scratching their head and wondering, you know, what's going on here? You've taken me to multiple different lenders. My transaction's not getting done. It's been months. What are we looking at here? Which leads to then lower closing ratios or lower closing percentages, and ultimately commission impacts, lost deals due to all of these different issues, and sometimes because of the truncation of brokers in a deal, very, very high commission requests, those transactions go away. Jay, any thoughts?
Yeah. What I'd add to it is really just, I think you guys get the idea, but you know, what we see a lot of is just we'll see deals. I mean, I will see deals, you know, the same deal, you know, 2-3 times a week. I've even seen the same deal from different brokers in the same day. And what it really brings us up against is just a function of just getting an idea from the borrower and getting their needs really validated. Is we do see a little bit where the brokers that are sometimes bringing us the deals, they're part of a daisy chain. They have not talked to the borrower, and therefore their knowledge of the borrower's real needs are totally divorced from what they're asking us for. There are certain deal structures that you're going to need that you know your borrowers need that these guys just don't have a grasp on. And so the key to it is really just having a discussion with them about the rates, the fees, the costs, how it's structured, just really understanding the roadblocks that stand between us and speaking with the borrower ideally, so that way we can, you know, fulfill their actual need. Do you guys have any questions about anything we've brought up so far, or? I don't really see anything in the chat room, Don, so I think we're all right.
Okay, terrific. Well, you know, bringing it back to the premise of this conversation, which is the competition in the marketplace. Those are some of the results of the competition, and but you know, navigating through that competition and dealing with that competition is really what we're going to be focusing on here now. Now, in the private lending sector of the marketplace, there's very little data. But by analogy, we can take a look at what's happening in other sectors of the market, other financial sectors. So looking at banking, for example, what has been going on is that kind of like what we're seeing in the private lending business, there's been an erosion of the banking business because of different people entering the marketplace. And just a few headlines about Silicon Valley coming and fintech and all of those different things that were occurring in the banking business. We can draw by analogy that we might be seeing the same thing in the private lending business. We're seeing in broad strokes Wall Street-based firms coming in. We're seeing a little bit of securitization occurring in the marketplace. Some foreign capital is entering the market. We're seeing a little bit more fund formation and things like that with different sort of platforms and then other market entrants. So when we think about the competition, we also have to think about the institutions that are in the marketplace and the other lenders that are in the marketplace, including banks. So when we look at this particular slide, small balance commercial real estate is defined as real estate transactions or real estate loans below $5 million. And this is on a national basis. This information comes from the National Association of Realtors. They put out a small balance commercial real estate survey every quarter, and this is the source information for this particular slide. And what we see here is that community banks and regional banks, as well as some credit unions and some money center banks, represent about 64% of all loans that are being made in the small balance space. There's a small slice here where we see private lenders, and private lenders represent about 11% of the marketplace. So we are a pretty significant and growing sector of the marketplace, but it's still fractionalized in a lot of respects. In other words, we're very, very regional or super regional. There are not many lenders that are lending on a national scale, at least dominating on a national scale. So it tends to be super, super regional. And one of the things that this has caused bankers to think about and pause on is who are their customers and why are their customers going to other particular lenders as opposed to themselves. Well, in the banking world, one of the surveys indicated that 33% of millennials don't even need a bank at all. So there's a shifting of the mindset and an approach in their business, and we have to look at our business the same way. There's a shifting of the approach of how we're getting our borrowers and how we're communicating with people. Now, today, more and more people have access to information online, and that's a good thing and a bad thing. It's a good thing because it's a little bit more transparent. The information comes a little bit more quickly. It's a bad thing because it's a low barrier to entry, and there's some people that are getting into the business that may not have that platform fully put in place, and that's where the bumps and scrapes come for some of the borrowers that may try those people out before they go to brokers and lenders that are a little bit more established. So the technology is able to speed things up. It allows us to pivot and move very, very quickly in the marketplace, but it also creates a little bit of a lower hurdle. So again, using the bankers by analogy, what was happening in 2011 is that most banks did not have an innovation strategy. About only 37% of them were looking at the marketplace, looking at their customers, and trying to figure out how they competed in the marketplace. Fast forward to 2018, over 74% of bankers now have an innovation strategy. In other words, they're really looking at this and they're saying, well, we've done things this way for a long while. What do we need to do to adjust to what's happening around us in the marketplace and what's happening with our customer base? So some of these banks have started to work with their suppliers. In other words, they're looking at fintech companies and looking at alternative lenders as suppliers of products and services that the banks may be able to offer. About 32% of the banks have invested in startup companies in order to compete, and a good portion of them are actually running accelerators or incubators to push out new products and services in a digital world. And about 20% of them are in the process of launching some form of a digital-only bank. So in other words, you can see that technology and innovation, as well as looking at the market a little bit differently, is what we're seeing with some of our competitors who are the banks in the marketplace. Some of these banks are also looking to get into different sectors of the market through acquisitions, mergers and acquisitions. BBVA is a Spanish bank, and it took a pretty significant stake in a UK bank and then acquired a whole bank in Sweden just to enter the digital marketplace. And then you've got a French bank that acquired a bank that was predominantly in Germany and the UK for that same reason. So this is great. This is all about banks, and again, very little information in our world except for the anecdotal information and some of the things that we're seeing with the competitors. And you're a broker that's not national. You don't have the same types of resources that some of these banks have. So as a lender thinking about an innovation strategy, or a broker thinking about an innovation strategy, there are various barriers to entry that you might have that others may not have. And the first one staring us in the face is the budget. Some of us might not have a couple of $1 million to put into pivoting and changing our strategy over time because it's just a very costly type of exercise. Competing on a different technology base or changing our infrastructure derives from that, as might the skills and experience. We might not have the right kind of talent on our team currently to pivot and do some of the things that we want to do. And then that boils down to the capability to fund loans, and do you have funding partners or dependable partners that might be able to assist you with that. So in terms of navigating the challenges, what we might be able to do is take a page from the banker's playbook and start to look at how banks work with each other in the marketplace. Now, as a former banker, I can tell you that when we were competing for loans on the street on a deal-by-deal basis, it was highly competitive. And we might have 3 or 4 different bankers competing for a particular loan. Very much like what we're seeing now in the marketplace, where we've got a number of different private lenders and a number of different brokers competing for a single loan. But once you get past that frontline type of competition, in the back office where the chief executives get around, the chief executives and the executives at different banks, they collaborate. And part of that is by need and part of that is by want. So for example, if I'm a banker and I've got too much of a certain concentration of loans on my balance sheet, I may trade some of those loans off. If I've got a concentration limit in a particular borrower, I might trade that loan off. Conversely, I might have a need for a certain concentration of loans, so I'll start buying loans. So what we see with the banking world is more and more whole loan sales. The bankers are doing participations, and there are different types of participations. There are what they call pari passu participations, where a bank will be equal in a transaction, both in terms of the income and the risk. And there are other participations, which are senior sub-participations or AB note participations, where you take a single note and you split it in 2, but the borrower never sees that split. It's a single note in their eyes, but as between the 2 institutions, one is taking a senior piece and one is taking a sub piece. And then the banks even have white label programs and bankers bank programs between themselves. So, if we look at how some of the banks are operating, we might be able to take a page from their playbook. Jay, you want to jump in?
Yeah, I mean, what we're trying to look at here is really a function of what we're kind of referring to as your deal, our financing. We see a lot of opportunities out there to partner with banks to either help them. We're looking for good partners and just a way to help them navigate some of these challenges. If we can find groups that have got solid groups that can execute, they've got a decent front end. I think Don alluded to the fact that a lot of what goes on in the beginning is the loan officers are competing for the data. Once it comes over the transom into the bank, it's a function of how we're sizing these things. If we can find groups that have got a decent front end, we'd like to help them with the back end to either help them offload risk, either by virtue of size or risk due to stabilization. Maybe they need to expand or broaden their geographic footprint. Maybe they want to expand into different asset types. But the key is just, it's not, what we're discovering is what we do is not always about pricing. It's got a lot to do more so with the knowledge of our, kind of our contact or our partner's relationship with the borrower and their respective knowledge of execution risk that the borrower is willing to tolerate or is adverse to. Urgency that may not be conveyed very well, but that there's something there this guy has got to get done, or perhaps it's just deal structuring that involves either things that are going to work or just simply aren't going to work as needed for your borrower. But maybe another example is a deal that we did with a bank here locally, where they were unable to. They had a great borrower, decent asset, but they were unable to value it as it was being appraised. And so what we were able to do is look at it in a little bit more creative way, tilt the picture a little bit, and we're able to do a loan with them where they did the first, we did the second, they were able to hyper amortize there first, which kind of melted the whole loan kind of like an ice cube until the loan fell into their lending parameters, and then we were just simply taken out by them. So it's those kind of examples of the kind of creativity that we're really looking for out in the market and are hoping to partner with people on. Is kind of the rundown. So if you're, are there any questions about anything that we've talked about so far? Or I don't see anything in the chat room, but want to give you guys an opportunity. So I think we're good to go, Don.
Okay, terrific. Well, that brings us to how Wilshire is competing. What are we doing in this marketplace? And that might be interesting for some of the folks on the call. What we're focusing on are strategic relationships. We're looking to build new relationships in the marketplace, kind of like what we said with the bankers that, as opposed to trying to build something from whole cloth within the organization, is it better to partner with other firms that may have the resources that you're looking for, and it's a kind of a plug-and-play kind of relationship. And on the other side of it, do we become a plug-and-play solution for the people that we're trying to partner with? So what we're doing is we're developing different types of broker relationships in the marketplace, and we're out there buying whole loans and mini pools because we are a fund. We have the capability to write some bigger checks that may be a little bit higher than what individual investors who might be buying trust deeds can do, for example. And that gives the partners that we work with an additional capital source that they might not have had initially in the beginning, and maybe makes them a little bit more competitive in the respective market that they're playing in. We're also doing participations. I've done a number of participations through Wilshire with both banks and other private lenders, as well as insurance companies and others. We've done them on a pari passu basis where we're equal. We've done them where there's a senior sub-piece where Wilshire has taken the sub-piece. And we've also done them where Wilshire has taken the senior piece and the counterparty is taking the sub-piece. So as Jay alluded to, we can get creative pretty quickly around here because of the fact that we've got the funds and the discretionary capital that we work with. And then we've developed a private label program. And that private label program, in a nutshell, is table funding. And as a result of that, the partners that we work with have direct access to our balance sheet, our checkbook. They're able to get some better pricing, some lower points, better rates. They get a little bit greater control over the transactions that they're working on because they maintain that control. They're able to get some greater client protections with the borrowers, and they're able to do what we were describing, and that is leverage our back office, leverage the people that we've got here, as opposed to hiring an entire group of people to get involved in small balance commercial real estate lending. They can rely on our team. And then they're also able to leverage our technology and our infrastructure. We continue to build out our technology here to make it a little bit more robust, a little bit quicker to do business with people. We've created different portals that the partners that we work with can log into and in real time see the status of different transactions, able to use various calculators that we've created so that they can see how we might underwrite a deal or partner with them on a transaction. So there's a number of different things that we're doing from a technology front that we're trying to push out to assist our partners as well. So with that, Jay, why don't you talk a little bit more and give us some closing thoughts?
Okay. So what we're obviously as we've been alluding to is the key as we see the market is really just a function of adapting and growing. I was told to me when I told my parents they were finally going to be grandparents, as they were smiling, my horror in my face was offset by my father saying, it's never a good time to change your life or change everything you're doing. And so that's kind of what we feel like we're facing, is there's not a great time to change everything that we're working on. We feel like it's time to make that change. As Don's alluded to with what's going on with the banks have set a very good trail for us to follow as far as broadening our footprint, adapting technology, a lot of the things that Don had mentioned implementing. But there's a lot of room out there, we think, for strategic relationships with really the whole spectrum of private lenders as we look across the country, and things that we do and don't do well. We need to find solutions to fill those gaps, or be the filler for the gaps that exist within our partnerships. And hopefully what we feel like we can do is offer up the ability to broaden someone's geographic footprint, leverage our strengths. We put a fair amount of money and time into trying to put together a back office that really, really works efficiently, and is a very logical bolt-on for the people that are out there that have a need for our unique set of skills and services. To the extent we can leverage our strengths, coupled with a partner that's got a good origination platform or a good front end, we feel like we've got a very reliable back end that can support and scale as our partners deem applicable in the areas that our partners feel like they need to grow into. We're very flexible. We can structure around pretty much anything. So as you see opportunities out there that you think, well, instead of saying no, perhaps we can convince you to say, maybe we should call Wilshire on this, or even not, if not us, someone that you partner with. But ideally, if we can avoid trying to say no to deals and say, you know what, let me hand you off to someone I know that's handled something similar, and give you the knowledge that you're handing it off to someone that will make sure that we look at it as your clients in the beginning, and we think they should be your clients after they've been through the bridge process. And so our allegiance to you guys is very strong in that respect.
Well, we have a couple of questions. I'm sorry.
Oh, I was going to say, and with that, I was going to say, if you had if there's any questions or anything else we could fill for you, we'd love to talk with you about it.
Sure. Jay, it looks like we've got a couple of questions. The first question is, if you've got multiple brokers bringing you the same deals, how are you choosing which broker to fund the deal with? Well, often what we find is that the brokers that don't have control typically will drop out of a transaction very quickly when we start to ask questions about the transaction. We will also, once we get to a certain point in a deal, we'll want to talk to the borrower directly as part of the due diligence process. And we'll often tell the brokers, hey, we've got a non-circumvention agreement. We can put that in place with you so that you feel protected. And to the extent that we can get directly on the call with the borrower, you're going to be on the call with us. And very quickly you'll find out that the party doesn't have direct access and doesn't have control over the deal. So usually it kind of filters its way out. With respect to some of the other partnerships that we have, the correspondent and the white label partnerships, those people get referred back to the correspondent for us to the extent that they're a broker that may have been working with that correspondent before. So we're protecting that relationship between the correspondent and the downstream person that they might be working with. So that's how we're approaching that kind of situation. But again, more often than not, it kind of filters its way out because you can very quickly get to a point of figuring out who's got direct access and control. What's beneficial about partnering with Wilshire? Jay, why don't you take this next one?
I think the benefit is, as I've kind of alluded to, is that we try and be, we can be as I tell our brokers, I can keep you as involved or uninvolved with a deal as you want to be. You're going to have borrowers out there that insist that you be instrumental in that deal. Other borrowers just simply want to basically be put in front of the group with the money, and then that's the relationship they want. So we are able to kind of be whatever you need us to be. I think as you saw in that previous slide, we really do kind of look at it as your partner or your relationship or our money. So we have the ability to provide maybe more aggressive pricing for some of our partners, so that way the pricing that they're going to see in the market from us will be better through the broker than it may be through us just calling them directly. And we've also got the ability, as I mentioned, to scale and bring you into areas, markets, and property types that you might not otherwise either be able to lend into or just simply not be comfortable with.
Yeah, you know what? I'm gonna throw a little bit of an additional comment on that as well. And I think that one of the benefits of working with Wilshire, and I take great pride in the people that we've got here, is our people. I think that we've got a number of talented individuals with deep experience in the lending environment. So that, coupled with the capital that we have, gives certainty of execution for the partners that we work with. And as a result of that, there's greater benefit to the brokers that work with us and the clients that they are bringing to us as well. So with that, there was another question. Can you review the details of the partnership programs? I think that the minute details of each one of those programs might be better suited for a one-on-one conversation with the people that are interested in those programs. They can reach out to Jay or I, and we would be happy to spend a little bit more time with you on how those programs operate and we do underneath each one of those programs. So I'm going to open that up for people that want to talk to us about that directly. What are your products? Are you nationwide? We are a bridge lender. So our program, if you will, is on-balance sheet bridge lending secured by multifamily and commercial real estate. As Jay had mentioned, we are focused on sort of the core assets in the commercial real estate world, such as office, retail, retail being strip centers as opposed to big box, warehouse, light industrial. We have a little bit of a niche in senior assisted living. We like that space a lot. We do assisted living facilities between 30 and about 150 beds, as opposed to senior housing and single-family residences. We don't touch any of that kind of stuff. We like student housing. We also like self-storage in the right MSAs. But we're not doing ground-up construction, land, or development. We don't do hospitality, and we don't do recreational properties like marinas. So when we're looking at the asset classes, we're going to be looking at sort of the core asset classes or the core food groups. In terms of the product itself, I like to think of us as a tailor. The loans that we get and the transactions that we do here, more often than not, are tailored to the specific needs of the transaction itself. And it's lending. We're a bridge lender, and more often than not, there's a little bit of a story or a little bit of spin to a transaction. And we're good at working through the issues, mitigating risk, and getting transactions done. With respect to lending nationwide, we are lending nationally, with the exception of Alaska. For brokers that are lending in a particular region or a particular segment, and you're looking to expand your footprint, and maybe your investor base won't tag along with you, we could be that investor maybe on those out-of-state deals that you're working on as well. Where can I find more information about your broker program? Again, a similar question. You can talk to Jay or I. I'd be happy to expand on that for you and provide whatever materials you'd like to see from us. Jay, why don't you take this one? This one says, what do you require in a loan submission? Many lenders have their own applications and input forms. Is it okay if we submit the loan on a 1003 loan application?
Sure. We are fairly we're fairly agnostic on how we get it. I mean, what we're looking at is we're more of an asset-based lender. So although the borrower's information is very important, really what we're looking at is we kind of accept it in any way, and we'd love to see in a perfect world, we'd like to see a rent roll, 1 year of operating statements plus year to date, and then to the extent there's renovations or a pro forma and a renovation budget is applicable, we'd like to see that. We do get a lot on the 1003 application, which is a great source to get a lot of the baseline data that we need. And then really any kind of market color you may have on whether it's an old appraisal or photos or just whatever we need just to get some color on what it looks like, what we're doing, and really just some information on the borrower. We just need to know what special sauce your borrower's got that's going to allow him to do what the previous owner couldn't do. Whether it's bring up to market rent or add some tenant improvements and some put some new HVAC on the property or whatever it is. We just need an idea of what condition it's in today, what it's going to become with your borrower, and really how you quantify getting in there. And then we do have, as it evolves, then we do have we have an application form, and we've got a number of things that we will use as we get into the transaction. But to size it is really nothing more than just, where it is today, what it's going to look like, and who your borrower is and what they're doing. It's really very simple. And then we will respond and ask you the applicable questions based on the execution that you need on it.
Yeah, and getting to that point, just expanding on a little bit of a glimpse of some of the partner programs that we've got. We'll brand some of the materials that we've got internally for the partners that we've got. So, for example, a letter of intent or a loan application would come from that partner as opposed to a big W on it for Wilshire. So. As Jay mentioned, we're looking for the information. We're looking for that baseline information so that we can quickly turn around and get you a quick yes or a quick no with terms when we say yes, so that you have good ammunition to work with your borrower and present the deal to them. And then from there, we can round out the package as we get deeper into the underwrite. Let's see. Another one here. Can you provide us with marketing information to use with our customers? Yes, again, with the white label program and some of the other programs that we've got with the broker partners that we work with, we've got a very strong marketing team here, a very strong marketing director, and branding some of this materials in a more generic way for some of the partners. We've done some of that. And again, for us, if we've got a good, strong partner that's delivering to us good volume and good quality loans, we're going to want to deepen and broaden that partnership with them as well. Jay, another question. How long does it take you to size a loan and get pricing details?
We can size it very, very quickly. I mean, we're really designed that if I can get the baseline information I mentioned to you, I can get a deal size within an hour. It really doesn't. We try and pride ourselves on getting in or getting out as quickly as we can. So we can get you pretty quick feedback, even if that feedback is, I'm not seeing the market that you're seeing. Tell me what I'm missing, but I will get back to you very quickly. And I will also add that if I'm missing something, if there's something in there that you simply are like, this guy is missing the boat, I'm not that proud. So also, by all means, call us and say, hey, did you see this, or what about this? And let's make sure that we're giving you a fair shake at what we're looking at. But we are designed to work very, very quickly. We can get an internal model done, within literally an hour, and get a document in front of your borrower that they can sign and feel comfortable with those numbers or what that thing's going to look like. And what I would also add is when we do send out our LOU, it has been vetted internally here, so we have that cash allocated for that deal when it's going out, or everyone's aware that we're putting the number out there. So there is no shortfalls of cash or any issues that would go along with the ability to actually fund and give you guys the confidence that the LOI means something from us. I think
okay, with that,
that's all we have.
Kat, any others that are out there? Any other questions?
I think that about wraps it up in the questions in the queue.
Okay, terrific. Well, just a couple of closing thoughts then. I think that, for the people that were interested in learning a little bit more about how they can partner with Wilshire, I invite you to give us a call. Please contact Jay or I, and we'd be happy to talk to you a little bit further about how we do things around here, and the types of people that we're partnering with, the types of deals that we're doing, and a little bit more of the in-depth detail about the different programs that we have. And, for us, when we think about the innovation strategies that are being put out in the marketplace, we're always thoughtful about how we can move the ball forward here at Wilshire. And some of that is based on the feedback that we get from you all, from the people that we do business with. So it's very much a relationship type strategy as well. We want to have good, strong relationships with the partners that we work with. and we want to be that reliable partner on the back end for the capital that they need for the real estate transactions that they're working on. So with that, I'd like to thank everyone for joining today. We really appreciate you taking the time out of your day. The contact information for us is on the screen. Please feel free to reach out with any questions or to use us as a resource. We look forward to working with you.
Thank you for your time, everybody.
Thanks, Don and Jay, for joining us for this webinar today and for presenting. And everybody else, thank you very much for coming along. And if you would like more of this kind of content, we do offer sessions at our annual conference every year. So feel free to go online at AAPLconference.com and find out more about that there. Thanks for coming. Bye.